Welcome to the deep dive. If you want to get the true pulse of the economy, you're always looking at that stack of government reports.
Oh, absolutely. The job numbers, inflation, growth figures.
Or the instruments, right?
Yeah.
They tell policymakers and investors where we're flying. But what happens if those instruments suddenly just fail?
Well, that is the critical scenario we're diving into today. A government shutdown isn't just about, closing national parks.
Right.
It halts non-essential operations. And that means stopping the flow of timely, objective economic information. This creates a data vacuum.
And suddenly, everyone's flying blind.
Everyone, from the Federal Reserve down to your average portfolio manager, you're navigating the economy without a map.
And we are not just speculating here. Our whole deep dive today is guided by a really intense piece of proprietary analysis. It's the Loop Market U.S. Economic Data Shutdown Impact Map 2025.
A fascinating document. It's authored by Devin McClarty, owned by D Investment Enterprise, and published by D Publishing Group.
So our mission is to break down that projected timeline. We're going to figure out exactly when and where the lights go out, and maybe more importantly, why that kind of uncertainty is so much more destabilizing than just getting bad news. Okay, so let's unpack this timeline. I think most people imagine a shutdown as this immediate on-off switch for disaster. But according to this analysis, the economic impact is more like a slow-motion catastrophe.
That's a great way to put it. The loss of information doesn't hit all at once. What McClarty's team really highlights is this progression. It cascades.
A cascade from what to what?
From recoverable delays to permanent statistical loss. And for you listening, understand that distinction is absolutely critical. So let's trace the projected status for late 2025.
Okay, let's do it. We start in August 2025, which the report labels as safe.
Safe is a very loose term here.
I was just going to say.
Yeah, what it means is that the data is delayed, but it is ultimately recoverable. We're talking about reports on trade, construction, factory orders, some early GDP inputs.
And why are they recoverable? What's the mechanism?
It's technical, but it's because much of this information accumulates. It's based on things like customs forms or cumulative sales figures. So it's late, but it will eventually get processed, probably by mid-November.
Okay, so frustrating for sure, but not a total loss. But then we move into September 2025, and the status drops to partially safe.
And now we're hitting the really sensitive stuff. September jobs report, the CPI, the PCC inflation data, all delayed.
Oh, wow.
Yeah, that pushes any recovery into late November, maybe even early December. This is the core data the Fed uses to judge inflation and the labor market. And it's going dark right when they might need it most. We're starting the fourth quarter with a massive information lag.
Which leads us directly to the abyss, October 2025. This is the one labeled compromised.
This is the projected full statistical blackout. This isn't a delay. It's projected as a permanent loss. And honestly, this is the most terrifying nugget in the entire McClarty analysis.
Wait, hold on. Why is October's data permanently lost when August was just delayed? I don't get the difference.
It all comes down to accumulating data versus snapshot data.
Okay.
For the October jobs report, the Bureau of Labor Statistics, the BLS, they rely on survey collectors who have to be out there visiting businesses, logging foot traffic, collecting wage data in real time during a very specific week.
It's a snapshot in time.
It is a snapshot. And if those BLS employees are furloughed, they simply don't collect that data. You cannot go back in November and somehow recreate what happened at a retail store on a random Tuesday in October.
So that information is just gone.
Gone forever. The critical, raw microdata for jobs, CPI, PPI, retail, trade, it may possibly never be published.
So it's not like a missing puzzle piece you can find later. It's a permanent hole in the fabric of economic history. That's a powerful idea.
It is. The market goes from coping with delays in August and September to suddenly staring into a blank, permanent hole where a full month of key economic activity should be.
How long does this permanent void last before things get back on track?
Well, the projection shows recovery starts pretty quickly. November 2025 is classified as recoverable.
Okay, good.
Data collection is expected to resume immediately. They'll prioritize the November jobs and CPI reports, plus those crucial GDP inputs. We'd expect to see a catch-up by mid to late December.
And after that?
Finally, December 2025 brings normalization. The system should return to its regular reporting schedule starting in January 2026, but that October hole, it remains.
So we have this profound, unfillable data gap, and it's right at the start of Q4, which is such a critical quarter. Let's get to the so what. How does this vacuum fundamentally change how the key players steer the U.S. economy?
The primary victim, without a doubt, is the Federal Reserve. Their whole mandate, maximizing employment, stabilizing prices, it relies completely on timely, high-quality labor and inflation data,
The jobs report, CPI.
and especially the personal consumption expenditures data, the PCE. That's their lifeblood.
You specifically mentioned PCE. We hear about CPI inflation constantly on the news. Why is losing PCE data so much more devastating for the Fed in particular?
That's a fantastic and crucial technical point. While CPI gets all the headlines, the PCE is actually the Fed's preferred inflation metric,
Why is that?
because the PCE index adjusts for consumer substitution. So if the price of beef skyrockets, CPI kind of assumes people keep buying that expensive beef.
Which they don't.
Right. PCE accounts for the fact that you might switch to chicken. It makes it a much more realistic gauge of actual spending and underlying inflation, and that's exactly what the Fed uses to set interest rate targets. Losing October's PCE means losing their cleanest look at inflation right before a major policy meeting.
Okay, so if they lose that data, couldn't they just, I don't know, use private sector reports like ADP for jobs or other market surveys to fill in the gap?
The McLarty analysis is really clear on this. Private reports, while they can be useful for sentiment, they just lack the scope, the historical consistency, and the nationwide rigor you need for federal policy.
They're not a substitute.
Not at all. They might give you an indication of a direction, but they cannot replace the official data the Fed is mandated to use. They'd be operating with what the report calls elevated uncertainty,
Which means?
which in policy terms means they're prone to making mistakes, overcorrecting, misjudging momentum. The analogy of flying a plane without instruments is spot on. They are forced to use anecdotal evidence and just hope for the best.
And of course, that chaos then ripples out to financial markets, to the analysts who need those numbers to build their models.
Oh, absolutely. For markets, the official source of truth just vanishes. So what happens? Volatility gets driven by noise, by rumors, corporate guidance, less comprehensive private data. The whole foundation of price discovery is compromised.
And for analysts trying to forecast Q4 earnings or GDP, they can't just pretend October didn't happen. They have to admit their predictions are now less reliable.
That's exactly right. They're forced into two major adjustments. The first is simply delayed modeling. The delays from August and September push back when they can even start building reliable Q4 forecasts.
Okay.
But the second, more technical impact is that they have to incorporate widened error bands across all of their Q4 models.
Let's dive into that phrase, widened error bands. For our listener, what does that actually mean for a forecast?
Okay, so imagine you're predicting revenue growth for a company. Normally, your forecast might be, say, 5% growth with an error band of plus or minus 1%.
So you're saying it'll be between 4% and 6%. Pretty precise.
Very precise. But now you lose October's official inputs, retail sales, producer prices, all of it. Your model loses confidence. That same forecast might now have an error band of plus or minus 7%.
Whoa. So instead of predicting 4 to 6% growth, you're now forced to say it'll be somewhere between negative 2% and positive 12%.
Precisely. It's a massive range. It is the technical admission that your precision is shot. You are signaling to everyone that your confidence in the forecast has plummeted because the underlying reality is simply unknowable.
And this brings us right to the core insight from the loop market analysis. The shutdown creates this data vacuum, and that is structurally worse than getting terrible economic news. The problem isn't that the October economy was bad. It's that we literally don't know what it was.
This is the profound psychological insight. It's what drives investor behavior in this kind of scenario. McLarty's team, they summarize the market sentiment perfectly. Markets don't fear high numbers, they fear no numbers.
Let's elaborate on that distinction. Known bad news versus the total void of no news.
Okay, let's use that inflation example again. Let's say the September CPI report comes out and it's terrible. Confirms 7% inflation. That's known bad news.
It's bad, but it's a number.
It's a measurable, concrete fact. Analysts can model it, strategists can adjust portfolios, sell certain assets, buy inflation hedges. The problem gets priced in by the market very quickly. It becomes a calculated, manageable risk.
So the market might dip, but it knows why it's dipping. It has a baseline.
Exactly. Now, contrast that with the no-news scenario. The October CPI report is never published. We have no idea if the economy slowed, stalled, or went into hyperinflation.
And that void gets filled with fear.
With fear and the absolute worst-case scenarios. Uncertainty paralyzes planning. Investors, they can't model Q4 earnings, they can't predict what the Fed will do, so they don't wait, they just sell. Indiscriminate selling, dumping entire sectors just to reduce exposure to the great unknown.
So the market sells not because it knows something bad happened in October, but because it doesn't know anything at all.
It completely removes the ability to make an informed decision. Predictability, even if it's predictably negative, is the core currency of the financial world. When your models completely break down because they have no inputs, the only rational response is to de-risk. And that instability creates far bigger, more volatile swings than any confirmed bad data ever could.
This has been a true deep dive into the cost of what you could call informational fragility. To wrap this up, let's summarize the three most important lessons from this McClarty analysis.
I think first is the structural lesson. A government shutdown causes this rapid escalation into a full statistical blackout, and that's projected to cause a permanent loss of key snapshot data, specifically in October 2025.
Second, the institutional lesson. This crippling lack of data creates so much uncertainty for key decision makers, especially the Federal Reserve. It forces them to operate outside their preferred metrics and really limits their ability to set effective policy.
And third, the psychological lesson. The core challenge is the data vacuum itself. The absence of information is just more destabilizing and fear-inducing for markets than definitive bad news, because it invalidates the very models everyone uses to manage risk.
And finally, let's leave you with a provocative thought that builds on this analysis. That permanent October data gap isn't just a zero in the economic math. It's a question mark so large that it corrupts the entire economic model for that period. The value of knowledge isn't just what it proves, but the certainty it allows you to build your own decisions on. So ask yourself, what key piece of objective information do you rely on to feel confident in your own life decisions, and what would happen if that input suddenly disappeared forever?
This analysis, which provided the core framework for a deep dive today, was based on the Loop Market U.S. Economic Data Shutdown Impact Map 2025, authored by Devin McClarty, and it remains a McClarty Source and D Publishing Group copyright asset. Thank you for joining us.